So what is dollar cost averaging? Well, it's simply the concept of taking amount of money that you plan to invest in the market and dividing it into parts and sections and investing over a period of time. It's very simple. This is what you do with your 401k, payroll contributions, IRAs. You make regular, repeatable contributions of investments. And what happens is you avoid trying to do market timing. You just put money in when it's available. Every paycheck, you put a little bit, you pay yourself first. It goes into into your investment, into your 401k, for example. That's what dollar cost averaging is. It's simple. What are the pros and cons? Well, the pro is it keeps you in the market. It removes some behavioral problems. And the con is, well, it's not mathematically the strongest answer. Mathematically, the answer is if you have a windfall, let's assume you have a windfall of cash coming in from selling, maybe sell a house or an inheritance or some other factor. So you've got a lump of cash. Would it be better to invest it all at once or to dollar cost average, let's say 50% up front, 50% over a 6-month time frame? Okay, so that's pretty clear. All up front, mathematically, studies have shown it's clearly the right answer. Put it in 100% up front. And not do dollar cost averaging. However, that works really well for your payroll contributions because it's repeatable. It's just an automated process. And then if we could do the dollar cost averaging for the lump sum, it's fine. What happens is mathematically, it's the better answer just to put it in all at once. And the reason why is because the markets tend to go up over time, right? Dollar cost averaging is a great strategy. And the reason why is it impacts the behavioral problems that we humans have. We're faulty at making comparisons. We have cognitive biases. And there's an entire discipline called behavioral finance associated with learning what we do, and we have all these behavioral traps that especially associated with money. So for example, if we were walking down the street and you find a single dollar, you'll reward yourself with maybe this much utils, this much benefit. And if you were to lose that same dollar, your utils or your benefit associated with that find would be higher. So you would kick yourself more for losing $1 than you would for finding the same dollar. So from a behavioral finance perspective, a lump sum cash, maybe for some people it's the right answer. Let's dollar cost average that so that we're reducing some of the concept of we put it all in at high, then the market goes down. Even if mathematically that the right answer is to invest it all up front as soon as possible. So a lot of times what we'll do is for repeatable, smaller donation contributions to your savings, we'll set that up as, a monthly contribution, dollar cost averaging, or if we were drawing down a portfolio, we'll take it out on a quarterly or monthly basis. And then for large inflows, it's a toss-up. It's not a math question, it's a psychological question. And our objective is to keep ourselves in the market longer and not be forced out of the market due to fear, making mistakes or errors or negative feelings associated with, you put in X amount of money and then the market went down, and we don't want that. So behavioral finance says, we have a lot of traps that we fall into. So dollar cost averaging is a way to avoid some of these, and it's a great strategy. You do it all the time with your 401k or your IRA contributions or your drawdown strategies. If it's a lump sum, it becomes a little bit more complicated, but again, it's a behavioral question. Anyway, I hope this sheds some light on the behavioral aspects of dollar cost averaging, and thanks for taking the time to watch. Appreciate it.